Embarking on the journey towards financial freedom often conjures images of a distant horizon, but the prospect of retiring in a mere decade, especially when beginning with a financial blank slate, might appear as a distant star on an otherwise dark canvas. Yet the blueprint for this ambitious aspiration rests upon principles that are refreshingly uncomplicated, grounded in the art of mindful saving, calculated spending, and astute investing. This narrative underscores a poignant truth. It's not solely the magnitude of one's income that propels them towards their desired goal, but rather the manner in which those earnings are managed, nurtured, and channeled toward a purposeful end. In the ensuing discourse, we'll traverse the planes of these strategies, plumbing the depths of the guidelines presented and uncovering how to chart a course towards retiring in a decade, even from the depths of financial insolvency. The narrative unfurls the notion that, paradoxically, the simplicity of the underlying principles is what renders this ambitious goal within the realms of possibility, irrespective of one's initial fiscal stature. The concept of saving over income for financial independence underscores that achieving financial freedom and early retirement relies not solely on high income, but on the proportion of income saved and invested. This paradigm challenges the notion that wealth is solely tied to earnings. Instead, it underscores the significance of consistent saving. Lifestyle inflation, the tendency to spend more with increased income, hinders wealth accumulation. A higher savings rate accelerates the journey to financial independence. Investing in these savings strategically multiplies their impact. This concept isn't about sacrificing happiness, but about conscious spending aligned with value. In summary, prioritizing a substantial savings rate, wise investments, and purposeful spending over a relentless focus on income can empower individuals to attain financial autonomy, pursue passions, and free themselves from the constraints of traditional employment. Moving on, calculating the retirement timeline based on savings rate involves a pragmatic and empowering approach to estimating when one can achieve financial independence. This method goes beyond the limitations of income levels by placing a primary emphasis on the percentage of income saved and invested. The fundamental premise is that the higher the savings rate, the shorter the timeline required to retire. By meticulously evaluating current income, expenses, and the envisioned lifestyle during retirement, individuals can ascertain the portion of their earnings that can be consistently directed towards savings and investments. This illuminating insight facilitates the projection of the number of years it would take to attain financial independence. This strategy effectively shifts the focus from merely chasing higher earnings to optimizing the savings rate, thereby underscoring the pivotal role of astute financial management in materializing aspirations of early retirement. This holistic approach, incorporating both income and expenditure dynamics, empowers individuals to take charge of their financial destiny and opens avenues to explore the realm of achievable financial freedom. Personal experience and mindset are fundamental elements in the journey towards financial independence. This perspective underscores the value of embracing frugality, strategic planning, and discipline. Shown through real-life examples, the transformation towards a minimalist lifestyle and prudent spending habits reveals the potential for substantial savings regardless of income level. This shift in mindset directs attention towards long-term financial objectives over immediate gratification, fostering a transition from consumer-driven habits to a mindset of creating value. Moreover, the significance of effective debt management is highlighted, promoting eradication of high-interest debts that impede financial progress. Leveraging low-interest fixed-rate loans for appreciating assets exemplifies a strategic approach to debt. Overall, the role of personal experience and mindset lies in shaping deliberate attitudes and behaviors that have a profound impact on the path to financial independence, offering actionable insights for those aiming for early retirement and financial self-sufficiency. Reducing expenses and living below your means encapsulates a core principle that underscores how achieving financial independence is grounded in the ability to save and invest a significant portion of one's income. This principle places emphasis on a distinction between gross earnings and actual savings, highlighting that the accumulation of wealth is not solely about income magnitude, but about what remains after essential expenses are accounted for. The recognition of living modestly and consistently, irrespective of income fluctuations, resonates as a potent example. Embracing a frugal lifestyle while resisting the allure of inflated spending enables the accumulation of capital that lays the groundwork for investments and eventual financial autonomy. This approach involves a reevaluation of the significance of possessions and experiences, fostering a deliberate and mindful financial relationship. This transformative perspective enables strategic resource allocation and prioritizes long-term stability over short-term consumption patterns. Strategies for cutting back on spending offer practical techniques to curtail expenses and redirect resources towards savings and investments. The approach entails a conscientious shift in consumer behavior, discouraging impulsive purchases while promoting the concept of delayed gratification. A significant focus is placed on distinguishing between essential needs and discretionary wants, advocating thoughtful contemplation before non-essential expenditures, often revealing the transient nature of desire. The strategy of house hacking is presented as a means to optimize living costs through real estate, alongside suggestions to economize through purchasing reliable used vehicles and developing culinary skills for home-cooked meals. The value of patience in purchasing choices is emphasized, advocating waiting periods to ascertain an item's genuine worth. Collectively, these strategies embody a mindset that encourages deliberate consumption, fostering a leaner lifestyle that enhances financial independence and accelerates the journey towards autonomy. High-interest debt and its impact on financial independence is a pivotal aspect of the journey to economic autonomy, emphasizing the detrimental influence of burdensome debt on the path to financial freedom. Such debts, accruing interest at exorbitant rates, can erode financial stability by diverting resources towards interest payments and inhibiting the accumulation of wealth. Addressing this challenge involves a dual approach, eliminating existing high-interest debts to redirect funds towards savings and investments, and adopting prudent borrowing practices to prevent their resurgence. By freeing oneself from the constraints of high-interest debt, individuals can unlock the potential of their earnings, fortify their financial foundation, and expedite progress towards the aspiration of financial independence. Investing for financial independence emerges as a pivotal element illuminated by the previous discourse, underscoring the transformative potential of astute investments in ensuring enduring fiscal stability. This perspective accentuates the significance of harmonizing investments with overarching aims, accenting the value of retirement accounts such as 401ks, Roth IRAs, and HSAs for both tax advantages and wealth accumulation. The narrative dismisses the efficacy of market timing, endorsing a steadfast long-term investment strategy and extolling the merits of low-fee index funds that echo market performance. This segment underscores that attaining financial independence hinges not on intricate investment maneuvers, but on disciplined practices aligning investments with objectives. Through the embrace of well-informed strategic investing and the nurturing of portfolios over time, individuals can lay a robust foundation for a self-reliant and financially secure future. The factors to consider for an accelerated retirement timeline encompass a multifaceted approach that hinges on key principles and strategies. Firstly, cultivating a high savings rate is pivotal. By consistently directing a significant portion of income towards savings and investments, individuals can rapidly accumulate the capital needed for retirement. Prioritizing a frugal lifestyle and mindful spending is crucial in this endeavor. Secondly, strategic investing plays a vital role. Leveraging investment opportunities such as real estate and low-cost index funds can amplify the growth of saved funds over time. Eliminating high-interest debt and managing low-interest fixed-rate debt wisely also contribute to financial progress. Thirdly, increasing income streams is paramount. Pursuing side gigs, freelance work, or entrepreneurial ventures can boost earnings and accelerate wealth accumulation. Fourthly, cultivating a creator's mindset underscores the potential of generating creating value through content creation, business ventures, or innovative ideas. Lastly, embracing delayed gratification and exercising patience in spending decisions enables individuals to avoid impulse purchases and allocate resources more effectively. This holistic approach encompasses disciplined savings, strategic investments, diversified income sources, a value-driven mindset, and prudent spending habits, collectively propelling individuals towards an expedited path to retirement within a shorter time frame. Determining a retirement timeline with real numbers involves a meticulous evaluation of income, expenses, and savings goals to project when financial independence can be achieved. By taking a comprehensive look at current earnings, expenditures, and desired retirement lifestyle, individuals can calculate the percentage of income that can be consistently allocated to savings and investments. This percentage directly impacts the timeline to retirement. The higher the savings rate, the shorter the time required to attain financial freedom. By extrapolating these calculations over a specific time frame, individuals can estimate when their accumulated savings and investments will reach a level that sustains their desired lifestyle without the need for traditional employment. This approach shifts the focus from solely chasing higher earnings to strategically managing finances, providing a tangible roadmap for realizing early retirement aspirations. Achieving retirement in 10 years necessitates a deliberate combination of frugal living, strategic savings, astute investments, and a growth-oriented mindset. The process involves prioritizing savings and investment percentages over income levels, and understanding that the quantum of savings is pivotal. Adhering to a disciplined and consistent lifestyle, regardless of income fluctuations, fosters capital accumulation. By curbing expenses, embracing mindful spending, and potentially exploring opportunities like house hacking, individuals can significantly reduce costs, eliminating high-interest debt while leveraging low-interest fixed-rate loans for appreciating assets accelerates progress. Intentionally creating additional income streams, whether through new skills, side hustles, or a results-based career, boosts financial growth. Calculating retirement timelines based on savings rates provides a pragmatic roadmap. Ultimately, an agile, value-driven approach coupled with calculated financial strategies can transform the aspiration of retiring in a decade into a reality. In conclusion, the path to financial independence may seem distant, but the blueprint for retiring within a decade is grounded in simple yet powerful principles. By prioritizing mindful saving, strategic spending, astute investing, and a growth-oriented mindset, you can transform this ambitious goal into a tangible reality. The canvas of financial freedom becomes clearer as you embrace intentional choices, shaping a future that's liberated from financial constraints. So, armed with these principles, embark on your journey towards early retirement with confidence, knowing that each step brings you closer to the horizon of your aspirations. Thanks for watching. Until next time.